time out. This doesn't feel really good. Make sure you understand their business plan. Let them walk you through it. Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in this how-to video, if you want to learn how to stop making mistakes or avoiding the bigger mistakes in syndicating a deal in multifamily, listen on. Jake and I created this 3-step framework for passive investors, but I always like to refer to it as if you're raising capital or you're a general partner or a lead sponsor, this framework is really vital to you because I want you to start looking at investing in multifamily from a passive perspective as if you're the general partner, but you have to look at it from that passive investor's perspective. We're always thinking about what's in it for me as the general partner, but you're trying really to create opportunity and try to solve a problem for that passive investor. And what is this 3-step framework? Real quick, before I dive into, I'm going to go over 4 mistakes. We call it the sponsor or the jockey. The second part is the alignment of interests, which is the saddle. And the third part is the horse, which is the deal. So think of the sponsor being the jockey. He's the lead jockey. He's the lead sponsor of this deal. The second one, he's sitting on a saddle. That needs to be an alignment of interests between the passive investor and the GP or the sponsor of this deal. And the third one is the deal. Now, what do most passive investors do? They focus first on the deal. You've heard it countless times if you're a GP or in the Jake and Gino community where people are joining or there's newer investors. They focus on, I need a deal, I need a deal, I need a deal, without thinking about their goals, without thinking about what's a deal to them. And if you're investing passively, the most important thing is that sponsor or that jockey. And obviously, does it align with your goals? If you're the general partner, that's how you have to think. That's what that passive investor is focused on. What's in it for them, and is it a deal for them? So let's dive into some of the mistakes. And before I dive into them, if you want to learn more about working with the Jake and Gino community, whether you're a passive investor, we have a passive investor pro program that's focused solely on investing as a passive investor. If you're a doctor, you're a dentist, you don't want to do this full time. You want to just get your capital, invest into deals. And it's important that you learn how to actually invest as an active investor, learn the frameworks that we have in the Jake and Gino community, and then learn how this 3-step framework works for passive investors. Just reach out to us. It's 865-800-3905, or just go to jakeandgino.com/apply. There's so many different ways that we've rolled out that we work with students and with members who want to scale their portfolio, whether it's passively or actively. And, before I go on and I tell you this framework and I tell you these mistakes, it's important for you to understand why I'm doing this. I started as a passive investor without even understanding I was investing passively. I was the person out there that had the money. I always heard, is your money working hard for you? Because I was working hard for my money. So I applied that principle. I've got some money. Let me go give it to somebody. I'm looking for a deal. I fell into that trap a long time ago and I lost a lot of money. And when I joined Jake and Gino, I never thought it from the passive investor side. I always thought it from the active side. How do you make money? How do you build this business? But there's so many people out there that can't do this actively. We have a duty to educate those passively, to be able to go out there and find those awesome general partners, those awesome deals that are being syndicated really well. And the second reason is if I create a stronger group of passive investors, it will hold the general partners to account. And any deal that isn't great, passive investor is not going to fund it. They're going to understand. The power of that passive investor program that I put together for me really is 2 parts. The first is the community of Jake and Gino members. The community has closed over 80,000 units. They've raised over $500 million of capital. The community is amazing. But more importantly, when you're looking at deals, you're going to have one-on-one coaching. So you're going to get a deal. You may not know how to underwrite it in the beginning. You're going to be able to walk through that deal with one of our coaches, and they're going to tell you the math. Their duty is not to tell you if it's a good deal or a bad deal. They're going to point out the highs and the lows, the expectations, the underwriting. Is it conservative? Does it fit your criteria? Whatever it is, they're going to walk you through it. So this very first mistake, I'm going to look at it from the passive investor side. There's no return on capital clause to LP investors or return of capital that doesn't return all of the LP before the GP is tapping into their returns. I wish I had understood or even known what that meant, because I may have gotten my money back on their very first passive invested deal. What that typically means is if I'm investing in a deal as a limited partner, I'd like to get my money back. before the general partnership team starts tapping into returns. Now, maybe there may be an escalation clause that says I get the first 8% return of this, and then maybe from 8% to 11% of the cash flow, there's a catch-up. And then from 11% to whatever, 15, 16, 20% to perpetuity, we split that. If you do a refinance, I like the LPs to get all of their money back before it goes to an LP-GP split. It just incentivizes the general partners to do better work. Now, for me, on my passive deal, unfortunately, I gave my money to who I like to call Maserati Mike because he had a really beautiful gold Maserati. He had no skin in the game. What I should have said to him was, since you have no money in the game, I put in $172,000 of hard-earned money. How about I get all of that money back before you even take or sniff an owner draw? Now, he could take property management fees because he's managing the property, possibly an asset management fee as well. Obviously, acquisition fees to put the deal together, but no draws whatsoever, no cash flow whatsoever. I need all my money back before you get any of it yourself. That probably would have incentivized him to do a little bit better of a job, and I wouldn't have lost all of my money, or he wouldn't have gotten paid as I was getting paid. So just food for thought. Think about that. It's important. You're aligning your interests. You're sitting on that saddle, and it feels good because the general partner and the limited partner are aligning their interests. Now, this next one is an acquisition fee, and it depends upon what part of the market cycle, what part of the market, how qualified the sponsors are, the size of the deal. Typically, acquisition fees can range from anywhere from 1% to 5% of the purchase price. So if you have an acquisition fee of 3% and the deal is $10 million, the sponsorship team is going to get $300,000 as an acquisition fee. It seems like a lot if you're a limited partner. Rule of thumb, or actually, I should call this a golden nugget. If you're an LP, and I've spoken to a lot of Jake and Gino members raising capital, the vast majority of limited partners do not ask what the fee structure is. Ask the GP team what the fee structure is. And if you're a general partner, make sure you know those fees really well. Don't stumble, be transparent, be open and honest. But I've witnessed anything more than a 3% acquisition fee on a deal that's, $3 million or more, it can be excessive. Now, if it's built in and you think you're going to crush these returns if you charge a 4% acquisition fee in a $10 million deal and you're going to get amazing returns and you can show that, then you can possibly get away with that. But I'm just cautioning limited partners out there. Anything more than a 3% fee, it may be a little too rich. Now, in this part of the market cycle, as we're transitioning down, going to a buyer's market, general partners may be a little bit more hungry for capital. That acquisition fee may drop a little bit. But I know in the heyday in 2019, 2020, 2021, there were some general partners that were doing 4% acquisition fees on $20 million deals. It's a significant paycheck. And listen, they deserve it. They've put the deal together. They're signing on the debt. They're doing all the work in order to be able to provide value for the limited partners. It just comes a point where it gets to be a little bit too rich. Now, for the sponsor, if you're a limited partner, these are two mistakes from the sponsorship side. The GP's business plan, it's vague. They're not supported by details and data. As the limited partner, you need to ask those tough questions. That's why it's important to join a group, to get mentored, to know what those questions are. Sometimes you ask a question to a general partner, they don't know. That's okay. It's better that they don't know and they'll get back to you than them trying to obfuscate the question and try to circumvent it. You want general partners to have a strong business plan. If I was a general partner raising money right now, Jake and I don't raise money right now, but our students do. But if I was, I would say I'm doing a value add B and C properties in East Tennessee. And I'd go over the median incomes that I'm looking for. I'd go over the building vintages. I'd go over the unit mixes. I'd say, this is what I'm doing with the property, and this is where I'm taking it. And I've got data to provide, the median incomes, no flood zones, what I'm trying to get as far as an exit, what my cap rates look like going in, going out, what my rent growths look like, what my expense growths look like, really being crystal clear on it and having the plan. And if you feel as if the GP team is just throwing something together and they haven't done it, and maybe they have done it, but they're not just being really crystal clear with what they're trying to accomplish, that's one of those things as an LP, you're like, time out, this doesn't feel really good. Make sure you understand their business plan, let them walk you through it, and let them give you examples. Hopefully they've gone through some full cycle deals, but if they haven't, get some examples. Look at some other types of deals in that market to see if that can happen. Now, this last one, I'm only going to give you 4. Next week, I want to share 4 more with you. There's several GPs involved in the same deal that don't have work for the same management team. They have little experience and little real estate. Now, this was the crux of the problem over the last 5 years. And Jake and I have been through a few market cycles. We've seen the ups and the downs. We didn't get into this bridge debt financing where people were buying stable deals with bridge debt. That's very risky. If you know what you're doing and you can move quick, you've got a great business plan, and you can align and tell your investors what you're trying to accomplish, you could pull it off. The vast majority of the investors over the last 4 or 5 years that failed had very little experience. All they were capital raisers. They weren't operators. And they didn't get together with operators. 0% interest rates for a decade will really create cheap money and will really create euphoria. And people have to place that money into an asset. And now we're seeing the repercussions of what's going on. So it's really important. Always looking at it from an LP's perspective. You're aligning your interests with the GP if they don't align. That's the first mistake that we see happening. And the second mistake is general partners that are not qualified and general partners that don't have a crystal clear business plan. Now, I hope you've enjoyed this video. I'm so honored and thrilled that you spend part of your day with me discussing and listening to multifamily. Listen, if you liked the video, give me a big thumbs up. I'd love to hear any comments. And listen, if you have a horror story, share it with me. I'm always open and transparent with you, because if you haven't made mistakes in life, especially in real estate investing, if you haven't had any mistakes in investing on any horror shows, then you just haven't been investing. But this show is here to help you with those mistakes. Let's share them. If you have any questions or comments down below, leave them, and I will see you on next week's How To. Take care, everyone. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.